Hey everybody, September 4th, the market update desk, NMLS 157524. It is the day before the all important, never duplicated, mostly wrong BLS jobs report. Let's kind of break down what we've got today from the ADP report. We did a brief update this morning. We'll go a little more in depth and talk about what else is happening in the market. So, also saw today that T. Rowe Price stock jumped after hours on word that Goldman Sachs is investing $1 billion in it. So that was kind of out of the blue. So stock market is starting out better than expected. So yesterday we got the Fed's Beige book, which is a report on all the different Fed districts, and that showed weak job growth and flatline conditions. Kind of was the weakest in a long time. In fact, 11 of the 12 districts said there was little to no job growth, while one said there was contraction. There were reports of higher inflation in the Beige Book, but the Fed is expecting that to be a short run due to tariffs, and they don't believe it will be long lived. Now, the ADP report today, as we reported earlier, came in at plus 54,000 jobs, weaker than expected of the 75,000. Average job growth over the last 3 months now stands at only 46,000 per month, down from the previous 3 months of 62,000 and down from an average of the last 6 months, which was 120,000. Pretty substantial decreases there. Now, goods producing businesses added 13,000 jobs in the report, while services producing companies added 42,000. The biggest area of weakness continued to be small business. And we said earlier that it actually was a little bit better than the previous month, but still not good. They added 12,000. Medium sized businesses only added about 14, and large were 18,000. Leading the way, which is still very interesting, when we look at the ADP, it shows hospitality and leisure were the leading areas, added 50,000 jobs, but that's in contradiction to the JOLTS report, which shows significantly fewer job postings and openings for leisure and hospitality. Um, Now, the weakest sectors were trade, transportation, utilities, and education services, shedding 17,000 and 12,000 respectively. Now, they don't break down specifically education and health services, so it's really kind of interesting. We're going to wait to see for the BLS tomorrow. We think the negative revision that we're anticipating could come specifically from that because it showed job growth last month. Job stayers remain, people who stayed at their jobs had a payroll increase of 4.4%. That's down from 4.5%. Uh, Job changers actually stayed flat at 7.1% wage increase. Now we had Neela Roberts, who is from ADP, and she spoke on CNBC this morning and said that workers are now working an average of 2 hours less a week compared to before the pandemic. Now, this is a structural way that companies can reduce cost without eliminating jobs. So it could be some of this, both initial and continuing claims filings for unemployment are actually skewed um, because companies may not be releasing people, they're just reducing hours worked. And as we talk about unemployment claims, initial claims rose 8,000 to 237,000. Continuing claims fell 4,000 to 1.94 million, still over that all important 1.9 million marker. Now we're seeing the 10-year Treasury sitting at about 4.19 today. It's staying pretty steady. Now, one thing we're going to pay close attention to tomorrow on the BLS report, besides just the headline numbers, is the U3 unemployment. Last month, that was reported at 4.2, but it was rounded down. It was, the hard number was 4.24, I'm sorry, 4.46. So just a whisker away from being upped or reported rounded up to 4.3%. So we're likely going to go to 4.3 on this next report tomorrow with an outside chance of 4.4. On a technical side, mortgage-backed securities, we've seen this very healthy run upwards, helping mortgage rates, and we bounce off the resistance level where we're at, and you can see some room to run if the BLS report comes in as we're expecting. But we've talked about that for 4 months now, 5 months, and it keeps getting blunted. If we can get the numbers where we think they'll be, mortgage-backed securities have room to run, and 10-year treasuries have this path again down to 4.12%. And if it comes in really ugly, it's got a path down to 4.04%. So we could get, if these come in where we hope they will, from a technical side on mortgages, we could get down into that mid to lower 6% rate on mortgages, which would then unlock some sellers to sell their houses and start to help absorb the demand sector from buyers and maybe start to get some balance. We'll break down tomorrow morning really quick. We'll give the headline, then break it down in depth in the afternoon. Give us a call, 616-293-2189. We're on call usually all day. We're looking to help get you pre-approved, help get your offer accepted with the strength of your experienced realtor. 616-293-2189. Have a great afternoon.